Chapter 4 covers the rules involved in transferring capital to a corporation. And the bulk of Chapter 4 is going to be about this topic we have before us now, transferring assets to a controlled corporation. So suppose you have a sole proprietorship and you decide now's the time to incorporate, change the business form from a proprietorship to a corporation. So how do you do that? Well, you form a new corporation and then transfer your business assets to the new corporation. And in exchange, the corporation will issue stock to you. You now become the stockholder of the corporation. The corporation owns all of the business assets of what was once your proprietorship. Transaction normally would result in recognition of gain or loss. You just transferred assets in exchange for stock, and if the basis of the assets is different from the fair market value of those assets, you would have a gain or loss equal to the difference, probably a gain in many cases. But Congress says we don't want to create a situation where you're reluctant to incorporate just because of the tax law. So they created Section 351. Section 351 says no gain or loss is recognized if property is transferred to a corporation in exchange solely for stock of the corporation, and the transferor or transferors control the corporation immediately after the transfer. So that's the basics of Section 351. Now what we need to do is look at some of the specifics here. What do we mean by property? What do we mean by solely for stock? That seems obvious, but we'll see that it's not quite. What do we mean by control? And what do we mean by immediately after? We're going to look at those 4 points in much greater detail right now. First of all, property. Any sort of asset can be property. Could be cash, receivables, securities, tangible assets like machinery and equipment or inventory, intangible assets, patents, trademarks, etc. Not necessarily legal assets like patents and trademarks, could be just processes that you have invented. That would also count as an asset, even if you don't have a legal patent on the asset. Services, however, are not property. So if you perform services in exchange for stock, that is not covered under Section 351. Next, solely for stock. That seems fairly obvious. That means if you receive anything other than stock, it's not solely for stock. And so does that mean 351 is completely out the window? No, it doesn't. If property other than stock is given by the corporation to the transferor, the transaction is not completely disqualified. But the other property is treated as boot. You may remember from Tax 1 when we covered like-kind exchanges that if you exchange property for other property of a like kind, that would not be taxable. But you could also give or receive something else besides the like kind property. Usually it was cash, but it could be anything. And if that other property is received, then the rule is no recognition of loss, recognize gain up to fair market value of boot received. So you still don't have recognition of loss. If you had a gain, then you would have a partial, perhaps, recognition of the gain, depending on how much boot you received along with your stock. What do we mean by control? Now, you think of control, well, in financial accounting, that's 50% plus 1 share. That's control. You have voting control over this corporation. And for financial accounting purposes, any consolidations you do are going to be based on that rule. For tax purposes, control always means 80%. They don't think it's control unless you have 80% or more of the voting power of all the voting stock plus 80% of any shares of non-voting stock that may be out there. For most corporations, just one class of stock, voting common, And so you have to have 80% or more of that stock in your hand. Now, notice it says transferor or transferors. You could have a group of people who own, let's say, a partnership, and they transfer the partnership assets to the new corporation in exchange for shares, and they all get shares which are in proportion to their partnership ownership interest. Well, maybe one person doesn't have 80% under that, but if all of them together have 80% or more, then they're fine. They have control. So it doesn't always have to be one individual. If it's a proprietorship and you're incorporating your proprietorship, then presumably you're going to be the one person who has all the stock at the end. So that would be control. But it doesn't always have to work out that way. Control may rest with a single individual or a group of unrelated persons as long as they receive the stock in a set of integrated transactions. That's the key. So you can't say, well, I'm going to give my property to the business now and get all the stock and then take on a partner a year from now, and that partner will get 50% of the stock for the assets the partner transfers in. That would be two different and separate transactions, not a set of integrated transactions. And so therefore, the second partner wouldn't get 351 treatment because they wouldn't have control. They'd only have 50%, and the other 50% is owned by you, and you got yours last year. So that's not a set of integrated transactions. Unless you planned it all that way to begin with, well, then maybe you could make that case. But if they happened separately, then they're not going to be treated as integrated transactions. Immediately after, that's easy. That means literally immediately after. The transferor could sell the stock as soon as it's received and still have 80% at the time of the transfer. As long as there's not a contractual obligation to sell at the time of transfer, then immediately after the transfer, the individual had control. So if you have two people each getting 50%, and then one of the two sells, it does not disqualify the transaction. Well, really not for either of them. The one who sells is immediately going to recognize gain when they sell the stock. We'll see why in just a minute. But the one who holds on to the stock will not have to recognize any gain and will not be able to recognize any loss if the two of them had control immediately after. As long as there was no contract, I will sell my shares to you as soon as this is done. Don't sign that contract. You can have a verbal agreement that we'll talk about it as soon as we're done. But if you are contractually obligated, that would invalidate the transaction. At least we can't count your shares as part of the transaction. And if that gets us under 80%, then it's not a 351 transfer. Transferor's basis in the stock received, just like a like-kind exchange, is going to be the basis of the property you gave up. But there will be some potential adjustments. If you did have to recognize any gain, maybe because you received boot, then add the gain recognized. But of course, when you do that, you also have to subtract out fair market value of boot received. That plus and that minus will frequently equal and offset each other, and so you're back to the basis of the property transferred. The corporation's basis in the property received will be similar, equal to the transferor's basis plus the transferor's gain recognized. We are not going to subtract out fair market value of boot received because, of course, the corporation paid that. And so, therefore, it can count it as part of its basis. At this point, let's do problem 426. This is a longish problem. Seth, Pete, Kara, and Jen form Kingfisher Corporation with the following consideration. Seth is going to give some inventory, fair market value of $96,000. Pete's going to give equipment with a fair market value of $99,000. Kara is going to give a proprietary process. Probably not a patented process, but it's proprietary. She owns it, and that's worth $90,000. Jen is going to give cash of $30,000. Now, Seth, Pete, and Kara are going to get 30 shares each, worth $30,000. So each share is worth $1,000. So that means Seth is going to get $90,000 worth of stock, but Seth is giving up inventory worth $96,000. So Seth is also going to get $6,000 of cash. Pete is going to give $99,000 worth of equipment for 30 shares, and so Pete's going to get $9,000 of cash. Kara has her $90,000 process, for which she will receive $90,000 worth of stock, so she's even. And then Kara gets $30,000 of stock, 10 shares, for her $30,000 in cash. And by the way, that's where the $15,000 going to Seth and Pete, $6,000 to Seth and $9,000 to Pete, that's where that came from. The corporation had zero until they did this. So $30,000 is going into the corporate bank account, but 15 of it's coming right back out in terms of payments to Seth and Pete. Okay, we'll assume that the value of each share is 3,000, so 30 shares is 90,000 and 10 shares is 30,000. Provide the following information. What is Seth's recognized gain or loss? Okay, so amount realized, 30 shares, that's $9,000. And cash of $6,000, total amount realized, $96,000. Basis of the property given up, the inventory, his basis was $30,000. And so he has a realized gain of $66,000. Just as I told you when we were doing like-kind exchanges in the fall, always calculate the realized gain. Don't try to go straight to recognized gain, even though you say, well, there's only $6,000 of cash received, so therefore the gain has to be, recognized gain has to be $6,000. Well, that's going to be true in this case. Recognized gain, which is going to be an ordinary gain because it's inventory, is $6,000. Basis of shares received, well, that's going to be the basis of the inventory plus the gain recognized minus fair market value of boot received. And so we'll add and subtract 6,000, and so we're back to 30,000. Letter C says, what is the corporation's basis in the inventory? And the corporation will take the 30,000 Seth's basis in the inventory and add to it the cash given to Seth to get a total of 36,000. Letter D, go to Peter. What is Peter's recognized gain or loss? First of all, realized gain or loss, 30 shares is 90,000. Cash is 9,000, so total amount realized 99. Basis of the equipment 45, so the realized gain is 54,000, and Pete will recognize 9,000 of it. Pete's basis in the stock is equal to his basis in his equipment plus the gain recognized minus fair market value of boot received, and we're back to 45,000. And the corporation's basis in the equipment is the 45,000 Pete's basis plus the cash given for a total of 54,000. Letter G, Kara's recognized gain or loss. She has 30 shares, 90,000. She did not get any boot. The basis of her process is 15,000. Not sure why. Maybe she had some expenditures to develop the process, and it cost her 15,000 to develop it. That would be the sort of basis she would have. So it's not just something she thought up and put down on a pad of paper. This is something that actually cost her some money to develop. So anyway, she has a realized gain of 75,000, but she didn't get any boot, so her recognized gain is 0. Her basis in the Kingfisher stock is basis of the asset she gave up, 15,000. And Kingfisher's basis in the process is the same as Kara's basis, $15,000. Then we have Jen's recognized gain or loss. Well, she received 30,000 shares. She gave up cash, which has a basis of 30,000. But she has a realized gain of 0, so clearly also a recognized gain. of 0. They didn't even bother asking for the basis of the cash, which would be 30,000, but that's apparently self-evident, so they didn't even ask it. Then they said, what is Jen's basis in the Kingfisher stock? And it's what you paid for it, $30,000. Okay, and then letter L. During discussions related to the formation of Kingfisher, Seth says, why don't I just sell you the inventory for $96,000 and then use that $96,000, use $90,000 of it to purchase my stock, at which point I will still have my shares, and then 5 years from now I will sell my stock. Why don't we just do it that way? And the other stockholders, Pete, Kara, and Jen, say, yes, Seth, you should really do that. You should absolutely do that. That's a great idea. Why don't you do that? But Seth asked the accountant, well, what do you think? Should I or shouldn't I? I'll tell you in a minute why it is that the other stockholders think it's such a neat idea. Here's the letter L. Today, Seth is going to, if he does the sale trick, he'll get an amount realized, $96,000 in cash. Now, some of that cash is going to come from the cash that Seth will put into the corporation. Because remember, the corporation's only got $30,000. So he's going to have to wait a little bit to get his $96,000 until he buys his $90,000 worth of stock. They can write him a check, but they can't cover the check until the corporation gets the rest of that money. But anyway, he's going to get $96,000 in cash. His basis, remember, was $30,000. This is a taxable gain of $66,000. And by the way, it's an ordinary gain because this is the sale of inventory, ordinary income. If he does a transfer, then he has, we already saw, a $6,000 realized gain right now. Again, ordinary because it is on the transfer of inventory, so ordinary income. We are supposed to assume that Seth's tax rate on ordinary income is 35%, and his capital gain rate is 15%. So the tax of 35% on a sale would be $23,100. On the transfer, 35% of $6,000 is $2,100. Note, this question was constructed looking only at the tax consequences to Seth. There is no reference in the question to the tax consequences to the corporation. Corporation's basis in the inventory, if it's a sale, would be $96,000 instead of $36,000. When the inventory is sold, the corporation would save $60,000 because its cost of goods sold would be $60,000 less. Multiply that by 21% corporate tax rate, that's $12,600 that the corporation saves. That is completely left out of this question, but I want to point that out, that $12,600 would be shared among all 4 stockholders in proportion to their stock ownership. That's why I thought Pete, Kara, and Jen would think, yeah, Seth, go ahead, do that sale. Great idea. Not such a good deal for Seth. Already you can see that he's paying $21,000 more. That's 35% of that extra $60,000 gain that Seth has to recognize in year 1. Then we go on to, well, what happens then in the year of sale? 5 years from now, Pete is going to sell his stock for $90,000. His basis is $90,000. He just paid $90,000 in cash for that stock. So there's a taxable gain of 0. If it's a transfer, $90,000. His basis is only $30,000 if he did the Section 351 transfer the way we originally described it. So he would have a $60,000 gain then. Notice that in both scenarios, it's a $66,000 gain. In the sale scenario, the entire gain is recognized as soon as he sells the inventory, and it's ordinary income. In the transfer scenario, $6,000 is recognized at the time of the transfer because of the boot he received. The other $60,000 is realized when he sells the stock, and it's a capital gain. Tax at 15%, well, 0 if he sells, he has no gain. 9,000 if he does the transfer. The total amount of the gain is exactly the same. The difference is 35% on ordinary income if he sells inventory, and 15% on the sale of stock when he sells the stock. That's why his taxes are so much less. The present value of that $9,000 at 6%, the factor for 5 years, 0.7473, that works out to 6726, obviously 0 for the sale. So the tax cost of the sale, 23,100 now, and the tax cost of the transfer, 2,100 now, plus 6726 present value in 5 years. So the transfer is going to save Seth 23,100 minus the 8826 in present value terms, which is a total of 14,274. Now, the fact that we are actually deferring this sale, that only accounts for 2,274 of the total, the difference between 9,000 and 6726. The main savings, 12,000 of that savings, is because the $60,000 is being taxed at 15% instead of 35%. 20% difference on $60,000 of gain, that's $12,000. So of the 14,274 saved, 12,000 is just because of the different tax rates, and 2,274 is because of the fact that we were able to defer the recognition of gain for 5 years. I will also say that the people who constructed this problem chose tax rates which are about as far apart as they can get, 35% versus 15%. If you're in the 35% bracket for ordinary income, you are probably in the 15% bracket for long-term capital gains. If you were in the 12% bracket for ordinary income, you would be in the 0% bracket for long-term capital gains. That's a difference of 12% instead of 20%. If you were in the 22% bracket, you would be in the 15% bracket. That's only a difference of 7%. Most of this difference, this whopping 14,274, is due to the fact that we have very high individual tax rate on ordinary income relative to the lower tax rate on capital gains. That's about as wide as that spread ever gets. Meanwhile, the corporation does have to pay $12,600. And so if you change the tax rates for Seth a little bit, it's possible that the cost to the corporation is greater than Seth's savings. And the cost of the corporation, again, that's spread among all 4 stockholders, whereas Seth's savings are Seth's alone. So there you go. Okay, so the textbook's a little sneaky with the way they constructed the problem. They only looked at Seth's personal savings, did not look at the effect on the corporate tax, and they chose their tax rates a little bit, they made it look as strong as possible a case for doing the 351 transfer. Now, there's also a letter M, prepare your solution using a spreadsheet software. We'll skip that. This was an interesting question, and it lets you work through the basics of a 351 transfer, which is really the main point. But that question L, I thought that was worth going over just because it was a little sneaky, and it's good to be able to catch when the textbook is being sneaky. So there we go. Okay, what else do we have? Section 351 can double the potential gains that can be taxed if appreciated property is transferred to the corporation. Notice that just that inventory, we had a total gain of $66,000. A built-in gain in that inventory. The value was $96,000, but its basis was only $30,000. And ultimately, Seth had to pay tax on $66,000 of gain. First, from the boot received, and then second from the sale of the stock, that built-in gain of $60,000 on the stock. Meanwhile, the corporation also has a $66,000 gain, which they recognize when they sell the inventory. So we've got double taxation of corporate income. It's a different form. Usually when they say double taxation of corporate income, they're talking about the fact that dividends are not deductible by the corporation, but they are taxable to the stockholders. That's double taxation of corporate income. But this is also a form of double taxation of corporate income. We had one $66,000 built-in gain. We did a Section 351 transfer, and now suddenly double. And the same thing's true for Pete's equipment. He had a $54,000 built-in gain, 99 versus 45. And so the corporation is going to have a $54,000 built-in gain. They can only depreciate that equipment on their basis of $45,000, even though its value is $99,000. So we are doubling up all the built-in gains. Same thing for Kara's process. Suddenly there's two built-in gains instead of just the one. Okay. So on the other hand, the ability to defer the gain by not selling your stock, if you're going to sell in 5 years, you don't get much deferral. If you're going to hold it for 20, 30, 40 years, then the deferral can really be quite valuable. But we are definitely doubling the potential gains that can be taxed on appreciated property when we do Section 351. You should always recognize that as a potential cost. And that's why maybe in some circumstances, Seth's offer to just sell the inventory and then buy the stock for cash might have made sense. But it's also the case that, hey, wait a minute, if we can double up potential gains with all this property with built-in gains, why don't we transfer in property with built-in losses and double up our potential losses? If depreciated property, that is property whose value is less than its basis, so depreciated in that sense as opposed to appreciated, potential loss would be doubled. But they say, no, wait a minute. The property with a built-in loss is transferred. You must reduce the corporation's basis by the amount of the built-in loss. In other words, go back to fair market value. So you don't get it both ways. If there's a built-in gain, then we're going to double up that built-in gain. But you don't get to double up the loss if it's a built-in loss. Doesn't seem fair, but you can see why Congress wrote that. But they did say, well, wait a minute now. We're transferring in an entire corporation here. Some of the assets have built-in gains. Some of the assets have built-in losses. Some of the assets, the basis is equal to fair market value, such as cash, and maybe some accounts receivable, and maybe other stuff as well. So they say, all right, figure out your net aggregate built-in loss on all the property transferred. If you have one, you might have a net aggregate built-in gain. Certainly the problem we just did, there were no built-in losses. It was all gains. So if you transfer property with built-in gains and property with built-in losses, then you do not have to reduce the basis of the lost property by more than the net aggregate built-in loss. Aggregate means take all of the assets together. Net means you're allowed to net the losses against the gains. Okay. So calculate your net aggregate built-in loss on the 351 transfer for all transferors. Remember, we're treating them as a group. If we had treated each of those 4 individuals in our problem individually, none of them would have had 80%. They would have had 30, 30, 30, and 10. But they were all transferring together. They all jumped in at the same time, and so that's why the control test was met. So aggregate means all of the property transferred, and that means by all transferors in that particular 351 transfer. The net aggregate built-in loss, if there is one, will be the limit to the amount of reduction in built-in loss that you have to do. And if there is no aggregate net built-in loss, if it's a net aggregate built-in gain, then you don't have to reduce the corporation's basis back to fair market value at all. If someone transfers no property to the corporation but just performs services, well, those shares cannot be counted toward the 80% control. So if Kara, instead of transferring her $90,000 process with a basis of $15,000, if she said, well, I don't really have any property, but I have the services I can perform because I have this expertise, that would not have counted. She would not have been counted as a transferor, and the other 3 stockholders only have 70%, so that would not have been a Section 351 transfer. But she was able to say, no, I have actually developed a process. It cost me $15,000 to develop it. That's an asset. So it's not just my expertise that I will let you avail yourselves of. It is an actual process which the corporation can legally own, even if Kara is the only one who knows how to run the process. That's a separate issue. She developed the process. It is an asset with a basis of $15,000, and therefore her shares will be counted. So therefore they did meet the 80% control test. If it's just services and the shares don't count, that could jeopardize the entire transfer. So what do? Someone provided services, maybe Kara has provided services, and that's going to blow up the entire 351 transfer. So they say, hey, Kara, throw in $10 cash. So it'll be $30,010. We'll take $30,000 from Jen, another $10 from you. That's where therefore you are now a property transferor. No, that will not count. That will not be sufficient. The service performer cannot be counted as a transferor with a nominal transfer of property. That will not be counted. And you say, well, all right, how much would she have to put in order to not be counted as a nominal transferor? There's a safe harbor. So this is not a rule. You do not have to comply with this rule. But the IRS has said, we won't question whether the person is a transferor if they put in property worth at least 10% of the services they perform. So if Kara is performing $30,000 worth of services rather than $30,000, rather than contributing a $30,000 process, then she'd have to kick in at least $3,000. So $10 won't do it, but $3,000 will. Throw in another $3,000. At this point, Kara's going to say, hey, another $3,000. I'm going to want more shares. But that's okay. Or we will pay you cash for $3,000 of your $30,000 worth of services, or something like that. We'll get it. We'll get you even one way or another. Contribute $27,000 worth of services, and we'll pay you for the other 3. Okay, you could do that, but she has now contributed at least 10% of the services that she's providing. Actually, a little more. She only has to put in $2,700. There's some algebra you'd have to work in, make sure that she's getting her 10%. Anyway, the point is, make sure that the property contributed is worth at least 10% of the services contributed, and they will not be considered nominal. Now, what if it turns out, oh, whoops, we're only at 9.7%? Doesn't mean you didn't qualify. It just means you're outside the safe harbor. So the IRS can challenge it. They have agreed not to challenge anything that's 10% or more. I would think if it's 9.7, they probably let it slide. But, they're open to do it. That's what safe harbor means. You want to be safe, get yourself inside that harbor. Problem number 30. Dan Knight and Patricia Chen, who are good friends. I don't know why they put that in there. The fact that they're good friends is absolutely irrelevant to this whole thing. Maybe there are a couple people the authors know named Dan and Patricia, and they thought they'd throw that in. I don't know. Anyway, Dan and Patricia form Crane Corporation. Dan transfers land worth $200,000, basis of $60,000 for 50% of the stock in Crane. Patricia transfers machinery worth $150,000, basis is $50,000, and provides services worth $50,000, and she gets 50% of the stock. Will the transfers qualify under Section 351? Yes, Patricia qualifies as a transferor. She is performing services, but $150,000 value of the equipment is way more than 10% of the $50,000 in services that she's performing. So she's well inside that safe harbor. So the transfer does qualify under Section 351. Letter B. What are the tax consequences to Dan and Patricia? Okay, Dan, his amount realized, $200,000 worth of stock. Basis of property transferred is $60,000. He has a realized gain of $140,000. Patricia receives for property $150,000 of stock. She also receives $50,000 for her services. Basis of the property she transferred, the equipment, is $30,000, so she has a $120,000 realized gain. Neither of those gains is recognized because of the fact that they received no boot for their shares. Patricia does have to recognize service income of $50,000. She didn't get boot for the services, but the stock she received for services is not part of the 351 transfer, and therefore, even though she is a transferor, so her stock counts for the 80% rule, but the $50,000 that she received for services is not a 351 transfer, therefore that's taxable. And stock basis is the basis of the property he transferred, $60,000. Patricia's stock basis is $30,000 plus the $50,000 because she had to recognize that as income, so she takes that stock at fair market value, so she's at $80,000 in total. Continuing, letter C, what is Crane Corporation's basis in the land and the machinery? Basis of the assets transferred, the land $60,000, the machinery $30,000. That's easy. And letter D, what are the results of the transaction to Patricia on her Form 1040? Assume Patricia is single, has no other income, claims a standard deduction. We'll use 2024 standard deduction is $14,600. Complete Form 1040, we're not going to do the form, but her taxable income, if that's all she had was service income of $50,000, not sure what she's living on. Maybe she had lots of savings in non-interest bearing accounts because apparently she had no interest income either. So, or she and Dan are good friends. Maybe he's supporting her. I don't know. Anyway, her service income is $50,000. He can't claim her as a dependent because she's got $50,000 of gross income. And we don't know if they're living together. But anyway, her standard deduction, $14,600. Taxable income is $35,400. Next, assumption of liabilities. When you transfer assets to a controlled corporation, you're probably not just transferring the assets, you're transferring the entire business, assets and liabilities. You're changing the equity from proprietor's equity or partner's equity to stockholder's equity, but the assets and liabilities, you're transferring all of them. So the corporation is now assuming liabilities that used to be proprietorship liabilities. In other words, liabilities of the proprietor, or partnership liabilities, liabilities of the partners. Any liabilities assumed by the corporation, that's boot. That's transfer other than stock, is the fact that you have now had liabilities of yours discharged. That's part of your amount realized that is not stock, so that's boot. Assumption of business liabilities, they say, we don't want to trigger recognition of gain just because your business has liabilities. You've got some accounts payable. Why would we want to make your incorporation more difficult just because you've got accounts payable? So they say, we're not going to trigger recognition of gain as long as the liabilities are less than the basis of the assets transferred. If the liability exceeds the basis of the assets transferred, then unfortunately you will have to recognize gain equal to the excess. If you're transferring cash basis receivables and payables, then the rule is a little different. what I was dealing with back there when I said accounts payable was accrual basis accounts payable, so that the taxpayer has already taken a deduction for the expenses that have not yet been paid if they are accrual basis. In the case of cash basis receivables and payables, first of all, receivables, well, that's just an asset with a basis of 0. But now the corporation takes it with a basis of 0. So it will affect your basis in your stock. You just transferred 0 basis receivables to the corporation. Corporation now has your receivables, and you didn't get to add anything to the basis of your stock for that value you just transferred. And the corporation now has an asset with a 0 basis, and when it collects those receivables, it's going to have income. The payables works the other way. The payment of the payable would have given rise to a deduction, so a cash basis account payable. You would have been able to deduct it if you'd paid it, but you didn't deduct it because you didn't pay it. That's not going to count as a liability transferred, even though it clearly was. When you are adding up all the liabilities transferred, does that equal or exceed the basis of the assets transferred? Don't count the cash basis accounts payable. That finishes the first part of our Chapter 4. So the first video on Section 351 transfers is done. There is a shorter video dealing with other contributions of capital to corporations, which we will do next.